Starting in Chapter 6, we have started merchandising or retailing, meaning that we're buying and selling a product instead of just providing a service. So we're going to go through some purchase transactions and sales transactions that are identical. We're just going to look at them from both points of view. First, we'll go through the sales portion, and then we'll turn around and use the same information to make the purchase. Okay. Anyway, we have Showcase Company. They're a wholesaler. They're selling to Balboa. They're selling something in the amount of $254,500. Terms net 30. This N/30 means net 30. The balance is due in 30 days. While the sales amount is $254,500, it cost us $152,700. Okay. Then later, Showcase is going to issue a credit memo for $30,000 because Balboa returned some merchandise prior to the due date. So there's a $30,000 return of the sale amount. That returned merchandise cost us $17,500, and we're going to make 3 entries. Well, it's actually more than 3 entries, but we have to make entries for 3 different occasions. First, we're going to take care of the sale. Then we're going to take care of the credit memo, and then we're going to receive the balance due on the check. Okay. So anyway, when we get to our journal page right here, first of all, there aren't any dates. So these dates are entirely made up. If you try to figure out where I got them from, I just pulled them out of the air. We know that Balboa owes us money, so we're just going to put accounts receivable dash Balboa. And most of the time up to this point, we have not put the name of the company into it. This is a subsidiary account. We learned about subsidiary accounts in Chapter 5 that we skipped. I'll try to remember to make a brief video covering subsidiary accounts. It can all be done in less than 5 minutes. But anyway, accounts receivable from Balboa, and they owe us $254,500. And we're going to recognize the sales amount, the same amount. Now, this is a perpetual system. We'll stop just briefly and talk about the different systems we can use for inventory. The perpetual system is what most of you guys are probably used to. You may not even think about it, but you go to Walmart, you buy something, be it a can of green beans, cashier slides it across the glass, you hear this beep. And I mention the beep because that is actually an auditory internal control that lets the cashier know that the item has been scanned. If you're paying attention, it lets you know it's been scanned as well. And if you were to hear it twice, you'd want to know why they scanned it twice. Anyway, so it does create an internal control there. Now, in addition to adding the price of the green beans to the sales amount, in the background, the computer is updating the inventory. It's letting Walmart know that you've bought that can of green beans and those green beans are no longer on their shelf. Okay, so it is perpetually updating the inventory with each sales transaction and each return transaction. That is the perpetual system. Then the other option that you have is the periodic system. The periodic system is in the appendix at this point for Chapter 6, but I'm going to go ahead and mention it because you need to understand the difference. Under the periodic system, you would just record the sales amount. You would not update the inventory. If you can imagine, well before you were born and there were no computers and the cash registers didn't have the ability to automatically update the inventory, what would happen is the cash register would simply record the amount of the sales and nobody was updating the inventory as you went. So while you had an idea of what your inventory was, you really did not have any kind of precise number until you took a physical inventory count. Now, both systems use a physical inventory count, but under the periodic system, the physical inventory count is necessary to come up with the amount. Under the perpetual system, the physical inventory count makes it more accurate because you will have what we call shrinkage. And even though you have a certain amount in your records of inventory, it's most likely that some of it's been stolen or broken or there's errors. So you use that physical inventory entry to just correct it, okay? Anyway, so both of them need it. Just in a nutshell, that's the difference between periodic and perpetual. So back to here. Since we are under the perpetual system, as soon as we have this sales amount, the next thing we need to do is update our inventory. We're going to move this out of our merchandise inventory and put it into cost of merchandise sold. Okay, merchandise inventory. And they told us it cost us $152.7. We've taken care of the sales and we've updated our merchandise inventory. Now at this point, I'm going to briefly show you the chart of accounts because we have these new accounts. I just mentioned merchandise inventory. Okay, that is a current asset on your balance sheet. I mentioned cost of merchandise sold. That's a new cost that we will have in our cost and expenses area. There are some other things in here. Sales, that is our new revenue account. That's easy enough to understand. There are some other accounts in here that we will spend a little bit more time on later understanding, but there's an estimated returns inventory. This is created during the adjusting process. And the customer refunds payable, that is also created under the adjusting process. For now, just understand that we have made an adjusting entry and it sets up this amount for liabilities for returns. Okay, here's a delivery expense that's also involved in this. Go back to our transactions. Maybe. Okay. So anyway, cost of merchandise sold and merchandise inventory. Now, the next one, it says that there's a return. That return had a sales value of $30,000 and it cost us $17,500. So what we are going to do now is we are going to use part of the liability that we set up during that adjusting entry I was just speaking of. We're going to use customer refunds payable, and that amount is $30,000. We're going to credit their account. Today. Okay, now we have to update the inventory because of the returned amount. And that returned amount again was $17,500. That's what it cost us anyway. So we'll put the $17,500 over here before I forget it. Okay, we are going to put that amount back into our merchandise inventory. And we are going to take it out of estimated returns inventory. The estimated returns was also created by an adjusting entry, and basically, just like the account title implies, we estimated the amount that was going to come back to us. We were recognizing that on the balance sheet. Now we have specifically identified what that merchandise inventory is, so we take it out of the estimated amount and put it back into the inventory account. Okay. Now we come down to the end and we are going to collect what is owed to us from Balboa. So we are going to get cash and we are going to credit the accounts receivable for Balboa. And we need to come up with the amount that they still owe us. They owed us to begin with this $24,500. Okay, so I'm going to take that. I'm going to subtract the amount that was returned right here. And the net amount then is $224,500. So that should take care of everything from the seller's point of view. Make sure I subtracted the right thing. 254 minus 3. That's right. Okay, so now we're going to come over here and we're going to do the exact same thing except we are going to do it from the point of view of the purchaser. Make the screen a little bit smaller. Okay, so we're still on September 1st. From the purchaser's point of view, okay, what did they get? They got merchandise inventory. And it cost them $254.5. And they owe somebody money. And I'm going to go ahead and put the name of the company that we owe. Showcase whatever, something. And we owe them $254.5. On the wrong side. Now, that is all that's necessary from the purchaser's point of view. They got inventory and they owe money. Okay, so now we're going to get to the point where we have the return. So on 9/15, okay, look over here what we did. From the seller's point of view, we used customer refunds payable and we credited accounts receivable. From the purchaser's point of view, we are going to debit our accounts payable. We no longer owe them $30,000. Zero. Okay. Now, while we have reduced our debt because we no longer owe it, we have also reduced our merchandise inventory. Okay. So that is handled. We get to the end of the month and we pay our balance. We are going to then be reducing our entire accounts payable. And we are going to be out the cash to do it. How much do we owe them? Well, we know the answer because we have it over here, but if we weren't looking at their records, we would know that it would equal the original amount of the liability minus the amount of the return, and we would get the same $224.5. There you go. Okay, so that's the first thing we're going to cover is these transactions. And you do have homework problems that are nearly identical to this. Okay. The next thing I'm going to do is show you a PowerPoint slide. There are lots of things that happen to merchandise inventory, and this slide does a good job of summarizing everything that happens in merchandise. Okay, if you buy or purchase any kind of merchandise inventory, that is going to increase the value of it. Remember, this is an asset account, so these debits increase the value. If you return something that you have purchased, that's going to decrease it and be a credit. If you buy something on terms of FOB shipping point, I'll talk about that more in just a second. You're going to have to increase the merchandise inventory by the cost of the freight. It's considered part of the cost of buying the merchandise, so you just go ahead and put that freight cost in there. If you sell merchandise, okay, that's going to reduce your merchandise inventory and it becomes cost of merchandise sold. If a customer returns something to you, it goes back into merchandise inventory and uses up part of this customer returns right here. Okay, now just briefly, let's have a discussion on FOB shipping point. There are two shipping terms that you need to know with this. The first one is right here, FOB shipping point. The other is FOB destination. Okay, FOB stands for free on board. It's a leftover term that you just really don't need to know that much about. Okay, but it's free on board, and it tells us when title passes. In this case, FOB shipping point, the title passes when the merchandise gets to the shipping point. It could be FedEx, UPS, some kind of carrier, whatever it is. When the seller gets it to the shipping point, title passes, and the buyer now owns it during the shipping. Now, the other is FOB destination. If it is FOB destination, that means title passes when the merchandise gets all the way to the destination point. And if that's the case, then the seller owns it during shipping. Okay? And there are implications based on who owns it during shipping. If you have FOB shipping point and the buyer owns it during shipping, we're going to assume in our text that the buyer is always responsible for the shipping cost. If they wanted insurance, they would have to pay for the insurance. If they were doing a physical inventory count, they would have to make sure they count that merchandise even though it's not on their property because they own it. Now, if it was FOB destination, remember that means the seller owns it all the way to the destination point. The seller would be responsible for any freight charges. The seller would be responsible for insurance. And if the seller needed to do a physical count or update their inventory, they would have to count it even though it's not on their property because they still own it. Okay, so that's FOB shipping point, FOB destination. Now I'm going to move on to a different slide. Let's talk about those adjusting journal entries that we used in the last one. Okay, there are a total of 3. 2 of them are mentioned here. There are 3 adjusting entries that we pick up for merchandise. One was the shrinkage I mentioned. I don't have a slide that I'm going to pull up for that. I guess I could. I don't know where it is. Anyway, the shrinkage one, you would credit the merchandise inventory to reduce it to whatever its actual value is, and you're going to put the amount of shrinkage into cost of merchandise sold. So you have a debit to cost of merchandise sold and a credit to merchandise inventory for shrinkage. Now, these 2 right here are where we estimate the amount of sales that are going to be returned to us. That's number 1. And then we estimate the value of the returned items that have come back to us. So it's 2 of them right here. And here's how they've got a setup of an example here. If you have this amount in sales and you estimate that 1% of your items come back to you, then you can estimate $7,154 is going to come back and make an adjusting entry for that. Now, where did they get this 1%? 1% is not a magic number. It's whatever that business has historically had. I promise most retailers have some kind of historic idea of the amount of sales that come back to them. Okay, it's part of business and they're used to it, so they would just make a guesstimate based on that historic amount. So here's what that's going to look like. They're going to go ahead and reduce sales by that amount, and they're going to set up that liability for customer refunds payable. This right here, what we're doing is we're using the matching concept that we learned back in Chapter 3. We want to match these returns with the appropriate sale so that everything is in the right time period. Now, for instance, if you are Walmart and you have a bunch of stuff sold in December, a lot of that stuff will be returned in January. Now, I know Walmart's year end is not December 31st, but let's just pretend it is for a second. Those returns that are in January, they really belong with the sales amount for December. So what this does is it would go ahead and reduce the December amount of sales, and then in January, they would simply use up this liability created for those refunds. This is the other part of it. They estimate the value of the inventory coming back to them, and they take it out of the cost of merchandise sold so that the current year can be correct and it is matched up with that. Okay. Now we're going to move on to a multi-step income statement. Okay. This is for Racine Furnishings Company. The problem gives us multiple details on accounts. Okay. The first thing you would do is give it a proper title. Again, you put the name of the company, income statement for the year ended March 31st, 2019. Remember to use that terminology for the year ended on your income statement. Now, this is a great example of the publisher giving you entirely too much information, or, well, I mean, just information that you don't need. Okay. So first thing we're going to do is go through and talk about where you would find each of these accounts, what financial statement, and your choices are income statement, balance sheet, or the statement of owner's equity. So the accumulated depreciation account, it should follow its asset. The asset is the building and the accumulated depreciation are going to be on the balance sheet. So you do not need this information. Kind of a bad job of crossing it out, but you don't need that for our income statement. Administrative expenses, you will need that. Okay, anything with the term expense is most likely going to be used here, unless it says it's a prepaid expense. In that case, it's an asset. Okay, building, we just said the building is going to go on the all of this. Okay, we don't need that. Cash, where do we find cash? We find cash on the balance sheet. Okay, need that number. Cost of merchandise sold, we do need that. Okay, that's going to be part of our income statement. Interest expense will be on the income statement. Capital and drawing are not. Okay, they will be on the statement of owner's equity, and the ending capital would be on the balance sheet as well. So we're going to cross those out. We're going to try to cross those out. Okay. Anyway, and over here we have merchandise inventory. That is an asset, so we're going to cross it out. We don't need it. Notes payable beneath it is a liability. We're going to find that on the balance sheet. We don't need it. Office supplies, that is a current asset. It's going to go on the balance sheet. We don't need it. Salaries payable, likewise, is a liability. We don't need it. And we do need sales. That is our revenue account. We need selling expenses, but we do not need store supplies. And that is the current asset. So let me just very quickly remind you what we do need, since this is so easy. We're going to need the administrative expenses. We're going to need the cost of merchandise sold, the interest expense, and sales, and selling expenses. Okay, so out of this whole list of things, there's only 5 numbers you actually need. Okay, we're going to start filling in things that we need. We have right here, we're going to put our sales amount, and sales are 2564 zeros. Okay. Now the next thing we're going to do is put the cost of merchandise sold. And that is 1,520,000. Now, if ignore those right there. If we take sales and we subtract the cost of merchandise sold, we get the term gross profit. Okay, and all that is the difference between what we sold and what it cost us to buy those items we sold. So our gross profit is a little over $1 million on this one. After gross profit, we're going to then put our expenses in place. Okay, we're going to divide our expenses up into selling and administrative expenses. Okay, they give us selling and administrative expenses. In total, selling expenses are 286,000, so we'll just drop that number in here. And the administrative expenses are 216. Make this a little bit lighter here. See our numbers. Okay, now we're going to total our expenses. That is just an addition of these 2 numbers over here. Okay, total expenses are 502,000. We know our gross profit is 1,044,000. Our total expenses are 502,000. That gives us income from operations. That is not the same as net income. Remember, then we'll talk about that. Income from operations is 542,000. Now, like I said, that is not the same as net income, and let's try to differentiate between them. We mentioned Walmart earlier. Let's say you're Walmart. Their income from operations should include all of their income from selling things, from their retail stores, etc. Now, if they happen to have a warehouse over in Bentonville that they rent out, that rental income would be other income. If they happen to sell off that warehouse and they have a gain or a loss, that gain or loss would be other income or losses. Okay, interest expense and interest income is always considered other. It is not created from operations. It is created from a financing decision. So we're going to put a label right here that just says other expenses. If we had income, we would put other income and expenses. This label can change slightly depending on your needs. The last thing we're going to drop in then is the interest expense, and that is, where'd it go? $4,000. Okay, now we can get net income. That is income from operations minus the other expenses. So our net income is $538,000. For a point of terminology, let me point out that this is considered a multi-step income statement, as I mentioned earlier. All a multi-step income statement means is that you have different sections involved. So here's a section showing gross profit. Here's a section that shows our total expenses. And then we have another section for the other income and expense items right here. That's all it means. If this had been a single step instead of a multi-step income statement, you would not differentiate all these places. You would just have all your revenues listed. In this case, it's just sales, and then you'd list all of your costs and expenses, including cost of merchandise sold, selling, administrative, and interest expenses all together to come to net income. You'd have the same answer. It would just look a little different. Now, another thing, remember, these are not debits and credits. This is just information being given to you. If we had more detail, it's entirely possible that we would want even a third column here. If we had detail for the selling expenses, we could put all that detail over here and it would add up to this 286 number. If we had detail to the administrative, we could put it over here and it would add up to the 216,000 total right there. The last thing I'm going to cover has to do with invoice amounts. Okay, I have pulled up this information for us to work with. You do not have a homework assignment that is exactly like this. However, you need to understand this information to help you with some of the other homework items and your quiz bank. Okay, so we are being asked, as the purchaser, how much would we owe at the end of all these different transactions? And there's 5 separate transactions. The first one, we are buying merchandise of $14,000. Okay, so the sales amount was $14,000. There is no freight information given to us. It's FOB destination. Okay, now, even though there's no freight, let's talk about who would be responsible if there was a freight amount. This FOB destination, if you remember, means the title passes at the destination place. So therefore, the seller would own this during shipping, and the seller would be responsible for the freight. Okay, so even if a freight amount was listed here, if we're coming up with what the purchaser owes, we would not use it. This right here, you would read net 30. It means the entire amount is due within 30 days of the invoice date. And then last over here, we have an amount that was returned, and that amount is $32.50. Okay, so if we have an original sales amount of $14,000 and $32.50 of it is returned, then we're just going to find the difference, and that is the amount that would be due on the payment date, $10,750. Okay. Now, the next one here has merchandise of $21,200 originally. And there is freight. It's FOB shipping point. That means title passed at the shipping point, and the purchaser is going to be responsible for that shipping of $380. We're not going to put it in there yet. It is $210 net 30. This $210 right here means that if the buyer pays within 10 days, they get a 2% discount on the invoice amount. Otherwise, the entire net is due in 30 days anyway. Under the perpetual system that we are working on, we are going to always assume that a buyer takes advantage of that discount. These discount amounts are actually very high when you consider them on an annualized basis. We're going to assume that they do. We'll deal with that in a second also. Now, there's a customer return and allowance of $4,000. I'm going to drop that $4,000 in here right now. Okay, and determine how much of the purchase was retained on a gross amount at least. Okay, they kept $17,200 of this. Now I'm going to apply the discount. So the discount is going to be 2%. 2% of this amount right here, $344. So now let's come down to a new total. We're going to have that amount minus the discount of $344. We got $16,856. We're going to add the shipping in last. We're adding the shipping last because we want to make sure we don't apply the discount to the shipping. The shipping is done by a third party and they did not agree to that discount amount. So the amount to be paid in full is that plus the shipping. Okay, so that is the amount that would be owed. Now, under these assumptions, we are assuming that the seller actually paid that shipping for us as a courtesy, and we are paying them back for it. So that's why it's being included here instead of being paid separately to that third party. Now, another thing to point out here, we have the benefit of hindsight in all these calculations. We know the amount that is being returned and everything as we go, so we can do this in the most simplistic way possible. If you were given all this information and you had to do transactions, you would do it a little bit differently. You would have a purchase transaction right here, and this would be at the net amount. Okay, and then when it was returned, instead of $4,000, it would be $4,000 net of the 2% discount. So you would be doing the discount in two different parts right there, but in total it would still equal $344. Okay, let's move on to the third one. We have a 16.4 purchase. Okay, there is no freight involved. It is FOB shipping point. The buyer does own it during the shipping, so the buyer would be responsible for freight if it was given to us. There's a 110 net 30 credit term amount here. Okay, so if we pay in 10 days, we get a 1% discount. Otherwise, the net is due in 30 days anyway. And there is a $900 return. So let's put a return amount in here and come up with the gross amount. Gross just meaning we haven't applied the discount yet. Okay, our discount here is 1%, so $155 can be deducted from that. And so we'll take the 15.5, subtract the discount, and it's 15,345. And since there is no shipping, that right there is our answer. We're going to move on to the fourth one. We have a $7,500 purchase. Okay. And I'm going to have to move this so you can see it. Okay, $7,500 purchase, $250 freight. It is FOB shipping point. Again, the buyer owns it during shipping. So the buyer is responsible for this $250 in freight. 210 net 30, they get a 2% discount if it is paid within 10 days of the invoice date. Otherwise, the net is due in 30 days anyway. Okay, and there's a $1,200 return. So let me put this $1,200 return in here. Find our net amount again. The $7,500 minus the returned amount here gives us $6,300. We said this was a 2% discount. Okay, so this is going to equal 2% of this right here, $126 discount. We're going to now subtract that discount from the $6,300. And then we're going to add the shipping in. Okay, the shipping is $250. So the total invoice amount is that plus the shipping. Again, remember we do not apply the discount to the shipping. So you can see the whole problem here. Sales amount, we subtracted the amount returned right here. Here we're subtracting the discount based on the $6,300. We've got a subtotal. Then we're adding the amount of the shipping onto that. Okay, the last one. Okay, we have a 28.8 purchase. It is FOB destination. That means title passes at the destination point. Therefore, the seller owns it during shipping and the buyer is not responsible for freight. The seller is. We have a discount of 1% if we pay within 10 days. Otherwise, the net is due in 30 days anyway. And there are no returns and allowances. So we're dealing with a 28.8 amount. And we said there was a 1% discount. So let's just take off the 1% discount. and find the difference between the two. That is the amount that would be due on that one based on the facts given to us. Okay. Now we've talked about FOB destination and FOB shipping point. I want to show you an invoice and apply that information to this invoice. Okay, I have brought up an invoice here to look at. You can see that Alpha Technologies sold to Net Solutions some HC9 printer fax copiers. Okay, now let's look at the information given to us here. It is 210 net 30. Okay, we can see the discount being given to us here. We have 10 days to pay and get a 2% discount. Otherwise, the net is due in 30 days. There's nothing magic about these terms. You know, we saw a 110 example in the problem we just worked. It could be 115. Okay, so it does not have to be 10 here. It doesn't have to be net 30. It could be net 45, net 60, whatever. It could say net EOM. If it has EOM, that stands for end of month. So, you know, these may vary greatly. Now let's look at this right here. This is what I was wanting to point out. This says FOB Cincinnati. We were talking about FOB destination and FOB shipping point. Let's apply that to an actual invoice. We can see that Alpha Technologies is in San Jose, California. So the shipping point is San Jose, California. The destination point is Cincinnati, Ohio. So since this is FOB Cincinnati, this is an FOB destination situation. The last thing I'm going to do is go through some of these homework problems and point a few things out. This is asking for the amount of gross profit here. Remember, we talked about when we were doing the multi-step income statement that gross profit is simply sales minus cost of merchandise sold. So here's the sales amount. Here's the cost of merchandise sold. Do a subtraction and put your answer here. Then once you get to the next part, it asks for gross profit percentage. Let me go ahead and calculate gross profit so that we can work this one all the way through. It is $786,000 in sales, and we have cost of merchandise sold is $542, $340. Therefore, $243,660 is our gross profit. Now, when it asks for the gross profit percentage, okay, we bring our calculator back up and we take that amount and divide it by the amount of sales, which is the 786 number, and we get a gross profit percentage of 31%. Make sure you convert it to a percent. You move your decimal place over 2 places to the right, and that's why it's 31 and not 0.31. Okay, and so let's hit my check and work. And I typed something in wrong. What did I type in? Give me a second. Okay, I fixed the problem. I just accidentally put a 9 in here instead of 0. Now the gross profit is right. The gross profit percentage is right as well. Okay, continuing to look through here. What's this? Okay, this one right here, you could just use check your works and work your way all the way through it, but try to process through the logic. When we were doing the income statement, you know, I asked you what financial statement would you find these accounts on, and that's exactly what's going on here. You know, where would you find accounts payable? You're going to find it on the balance sheet. What is its classification? It is a liability, and notice they even tell you that liabilities are starting with the number 2 here. What is a possible account number? Well, the only one that starts with a 2 is 210, so that would be your answer there. Okay, let me show you accumulated depreciation because it could be, you know, a little bit less obvious. Okay, financial statement, it is going to be on the balance sheet because it follows its asset right here. Okay, and its major classification is it is in the asset area. It's a contra asset, but it's still an asset. Now, the possible account numbers, they give you 2 that start with 1 right here. You're going to choose the second one. What they've done is they're reserving the first one for the asset itself. So I'm going to assume that 125 is the office equipment and 126 is going to be its accumulated depreciation account. So you'll go through all of these right here doing that. Okay. When we get to exercises 14 and 15, these are just like the transactions that we went through at the very beginning of the video, sales related and purchase related. We get to the next one. We haven't talked about sales tax, but sales tax is pretty intuitive to most students because it's something we have to deal with every day on our own purchases. You know, we go to Walmart, you buy something, they will collect sales tax from you. They don't get to keep that sales tax. They are going to set all that sales tax up in a sales tax liability account that they have to pay to the state on the sales tax due date. So, you know, being in the month of September, the state would give us, if you're in Mississippi or Tennessee, the sales tax due date is the 20th of each month. So on the 20th of October, we would send to the state the entire amount of sales tax that we collected for September. Now, some of the examples in the text use the 15th for a due date, and that's fine. I assume there are states out there that use the 15th for a due date, but I just know unless they've just changed it, the 20th is the due date for sales taxes in Tennessee and Mississippi. One thing that gets some small businesses in trouble is they will collect all the sales tax and they don't really put it aside and they start spending it. So be careful. That is not your money. You have to pay it to the state. Okay, normal balances. You should start getting, if you're not already used to it, we're going to practice some more and get used to normal balances. You know, we know sales is a revenue account, so it should have a normal credit balance, for instance. Liability accounts, ask yourself, what is the normal balance of any liability? What's the normal balance of any expense? Okay, the cost of merchandise sold, those goes with your costs and expenses. So work that out and you'll be fine. Now, this is the shrinkage. I mentioned that earlier in the video. The shrinkage, as we said, was intended to correct merchandise inventory to match the actual physical count. So in this case, our records indicate this amount right here should be on hand. Our physical count is this. So all we do is we find the difference. We put the difference into cost of merchandise sold and we take it out of merchandise inventory. It should always be a credit to merchandise inventory and a debit to cost of merchandise sold. Your physical count is not going to be higher than your records say. It's always going to be lower due to theft or errors or, you know, whatever. Okay, so you're going to find the difference, debit and credit these accounts for those amounts. This is the multiple step income statement that we did. Okay, and last but not least, you have a ratio. Just click your ebook, bring up that objective, and it will show you how to do that ratio. I think we've covered everything that you need to know from Chapter 6, so send me an email if you need more help.